Hello friends, here I'm back with a new video on fixed deposits and stay away from them. Here are the 5 reasons for you to stay away from fixed deposits. Majority of our videos are more than 10 minutes of duration. Maybe they may be boring, but I would request you to watch this video till the end so that you come to know all the facts about the fixed deposit and you make an informed decision about your own investments. Many who may be the newbies in this investment world will make an informed decision. And if you already know about the fixed deposit and you are already staying away from it, if you are in conclusion with this video, please do subscribe, share it to the person whom you think will require it the most. So let's start with fixed deposits. Many of the people who invest into fixed deposits do not know the full form of, do not recognize it by fixed deposit. They just attribute it as FD. So if you ask a person how many fixed deposits do you have, the question which comes to their mind is what is fixed deposit? They just know it by the name of FD. They have a saving bank account and they open up a FD or a RD. So they do not know what this fixed deposit is and how do they work. They invest it because it's a herd mentality. Our ancestors, our grandfathers, our great grandfathers have been investing into fixed deposits, getting the fixed returns, and they think it's the safest instrument available in the market for investment, which is not the criteria, which is not the real fact altogether. So, how does the FD work? The FD works, the investor, the person who is giving the money, who is depositing money, is the lender. So, it is basically a debt instrument. One is basically giving a loan to the bank or the company deposit. So, the investor here becomes the lender. So, as the banks take the money, they agree to pay upon a fixed return, that is the interest which is already agreed upon. So this is the fixed return they are getting. So banks are no big great financial institutions. They earn from the consumers or from the customers itself. They give you a lower interest rate for your deposits, the fixed deposits, the recurring deposits, the saving bank account deposits, and they lend the money at a higher rate, maybe the personal loan, the home loan. So if you check the interest rate of all this which you lend to the bank or which you borrow from the bank, the borrowing interest rates are very high compared to this fixed deposit interest rates. So this margin of interest which they get from the banks get make them richer. So these fixed deposits do not make you rich. Let's see how so, what is the truth behind it. So before going into fixed deposits, let's understand something about inflation. So inflation is the biggest enemy of a common man. So what is inflation? So inflation, it is basically increase in the prices of consumer goods. That could be food, grains, clothes, other commodities and services. Supposingly a good today is costing 100 INR. After 1 year, the rate is 108. So that is the inflation rate. So the inflation is at what? So what is the inflation rate? So the inflation rate is approximately 6 to 8% per annum. Every year, the commodity, the services rates increases at a rate of 6 to 8%. So any good which is now 100 rupees will be maybe 108 after a year from down the line. So this is inflation. So we come to our next question, which is the best investment? So we have read about inflation. So your money should work for you, and the value of the money after 1 year should be higher than the inflation rate. That is again post taxation. So any investment instrument which gives you such a return consistently. So 1 year is a short term period. Consider 3, 4, 5 years down the line. So any investment instrument which gives post taxation returns more than the inflation is one of the best investment solution. So if you know this basic step, you will have no double thought to select any investment instrument. So please keep the inflation rate in mind while selecting any investment instrument. So let's know something about what are the income tax brackets. So as per income tax rule, any income earned less than 2.5 lakhs in a given financial year is exempted from any income tax, and income which is between 2.5 to 5 lakhs is taxed at 10%. Any income between 5 to 10 lakhs is taxed at 20%, and any income more than 10 lakhs is taxed at 30%. So if one is earning 11 lakhs, so the 1 lakh is taxed at 30%. So one ends up being 30,000 as the income tax. So this rule is applicable for individual income tax. So this is important to take into consideration while selecting your investment instrument. So inflation and income tax brackets are two important things you need to consider while selecting any investment instruments. So remember two I's, the inflation and the income tax bracket, before you go for investment. So two I checkpoints before investment. So returns from fixed deposit. So majority of the banks offer interest rate no more than 6.75%. Even after compounding, it's no greater than 7%. And please consider this is the pre-tax return. So even the pre-tax returns are not in horizon with the inflation index. So let's see what are the post-tax returns of a fixed deposit. So if an individual is in the 10% bracket income tax, that is income is less than 5 lakhs, the interest rate, if you consider it to be 6.5 percentage for simplicity, all these calculations have been simplified, not taking compounding interest and other factors into consideration. So it is basically a simplified version. So if the interest from the fixed deposit is 6.5%, so from the 6.5% you need to minus 0.65%, that is 10% of the 6.5% interest earned is taxable at the 10% slab. So the post-tax return is 5.85%. For individual in 20% bracket, it is 6.5 minus 1.3. That is, the 1.3 is derived by calculating 20% of 6.5. So the post-tax return is 5.2% for the individuals in 20% bracket, and for the higher income bracket people in the 30%, the post taxation return is 4.55 percentage. So you can clearly see none of these post taxation returns, even in the low income group, doesn't beat the inflation. It is well below the inflation. So for the investment to be ideal, it should beat the inflation by a huge margin. And also remember, there is TDS or tax deduction at source on fixed deposit. So any interest earned more than 10,000 Indian INR in a financial year is taxed at the 10% by the bank. So directly the TDS is cut and the interest is paid to you. So after that you have to file the additional thing while filing the income tax and pay the additional taxes at your income tax slab. So other myth is fixed deposits are the safest investment instruments available. Fixed deposits or FD, which we commonly call, that is not the case. Only 1 lakh INR is insured as per the RBI policy. So in common terms, if a bank goes bankrupt, the RBI is bound or does compel the banks to return only 1 lakh of your investment till date, irrespective of your holding. Even if you hold any amount more than 1 lakh, the minimum, the maximum amount you get back is only 1 lakh. So they are not as safe as you consider. So please do consider this criteria also while investing in fixed deposits. Many of the people, they think if the bank is deducting TDS for the interest earned for more than 10,000 rupees in a financial year, so what do? They split their FDs into multiple deposits and into multiple bank accounts. This you can do it for your convenience, but while filing income tax, you have to declare all the interest from all the deposits held in all the banks put together. So that will be again taxed at your highest tax bracket. So if you are in 10% bracket, it will be taxed at 10%. If you are in 20% bracket, it will be taxed at 20%. If in 30%, it will be taxed at 30%. So how much ever you try to play with this, legally you will be bound to pay the taxes at your highest slab. So do not play around selecting multiple bank FDs into multiple bank accounts. So these are the five reasons you need to stay away from the fixed deposit. The pre-tax returns itself do not beat the inflation. The post-tax returns are well below the inflation index. The returns are fixed. So it is fixed. You cannot achieve more interest than this. The banks will get richer and not the investor. And there is also interest rate risk. So if you make a FD today, tomorrow if the FD rates increase, you'll be stuck at a lower interest rate. So these are all the risk factors. So in a nutshell, it is important to stay away from fixed deposits as the investment tool for your debt asset allocation. There are other ways in which you can allocate them that will be discussed in our next video. So I hope this video was helpful to you. If you like this video, I would suggest you to subscribe to my channel, and also please do share this so that we increase the financial awareness and every investor does take a informed decision making while selecting the right investment tool.